All right, we're going to take the three-column approach that we learned in segment 1, and we're going to apply it to calculate our various variances. We're going to start with the direct materials, price, and quantity variance. So we're going to use an example throughout the entire chapter for Glacier Peak Outfitters, and they're giving us some information about the company. They make fiber fill, or they use fiber fill in their mountain parkas, and it tells us that the standard is 0.1 kilograms of fiber fill per parka at $5 per kilogram. Then it says last month 210 kilograms of fiber fill were purchased and used to make 2,000 parkas, and the actual material cost is $10.29. So now what we have to do is figure out where to put all of these numbers. Well, the first step is going to be to set up our three-column approach. So it's actual quantity times actual price, actual quantity times standard price, and the standard quantity allowed for actual production times the standard price. So 0.1 kilograms of fiber fill per parka is going to be part of our squab. We're allowed 0.1 kilograms per parka. So we're going to take that 0.1 kilogram standard allowed per unit times the number of parkas we actually made, which is 2,000. So that gets us a squab equal to 200. So we should have used 200 kilograms of fiber fill to make the 2,000 parkas. Then it says that the price was $5 a kilogram. That's the standard. So that's our standard price, which would be 5. And then it says last month 210 kilograms were purchased and used. So actual quantity would be the 210. And then we made 2,000 parkas. We already used that to get our squab. Now, one thing that students mess up on is they see, oh, we made 2,000 parkas. They put that in for actual quantity. The actual quantity that we're inputting here is the actual quantity of materials, because we're doing the materials variances right now. It's not the actual quantity of final product. The actual quantity of final product is used only to arrive at our squab. It's not the actual quantity numbers here, because these relate to materials. And the actual quantity of fiber fill, which is the material we're talking about, was 210 kilograms. Then it told us that the total cost was $10.29, so that would be the total of column 1. With that, I can now get my variances. So the first thing I can get, which I don't need to, but I like to, and I'll tell you why in a minute, is get my actual price. So if I take my $10.29 and I divide that by the 210, I figure out my actual price is $4.90 a kilogram. I don't need that to get the variance. I just need the total in each column, but the reason I like getting that per unit is it's going to help me determine my FUs. So 210 times 5 is my middle column, so that's going to give me 1050 in the middle, and then 200 times 5 is 1,000 in the third column. And then the difference between the columns is my variance. So the difference here is, I believe, going out on a limb here and using my brain instead of a calculator, 21. And then the difference here is 50. And then we got to figure out our FUs. Well, the actual is always on the left and the budget's always on the right. So in total, the 1029 is less than the 1050. So I spent less than I was allowed. So that's a favorable variance. But I like looking at the per unit. 490 is less than $5, so that also supports the fact that it's a favorable variance, because I spent less per kilogram of fiber fill than I was allowed to according to the budget. Looking at our, that by the way is our price variance. Looking at our quantity variance, we compare the 1050 to the 1,000. If 1050 is actual and 1,000 is budget, that would be an unfavorable variance. Again, you're treating the left-hand side as actual, the right-hand side as budget when you're figuring out your F and U's. Because these are costs, everything in this chapter are cost, I always want actual to be lower than budget. And if it is, it'll be favorable. When actual is more than budget, spending more than I planned is never a good thing, and that results in an unfavorable variance. But I like looking at the per unit amount. So the actual quantity I spent was 210 kilograms, I was only allowed to spend 200, so I spent too many kilograms, or I used, I should say, too many kilograms, and that also supports the unfavorable variance. We can double check our work by adding our variances together. If you remember back in chapter 9, we learned that if we have a favorable or an unfavorable variance, we take the difference, and that gets us our total, which in this case is 29, and because the U's are bigger, it's an unfavorable variance, and that is indeed the difference between column 1 and column 3. The $29 is that difference. So that's my overall flexible budget variance, and it is unfavorable because the actual of 1029 is more than the budget of 1,000. So that's a good way to double check our work, making sure not only that our numbers are right, but it even can double check our FU analysis, favorable and unfavorable that is, to determine that we're on the right track. So that's the process that we're going to go through. Now, the good news is if you're still a little confused, when we go through more examples, it's going to be done the same way every time, whether it be another example for direct materials or whether it be direct labor or variable overhead, the process is exactly the same. So here it is all typed and pretty. If you couldn't read my writing, you could pause the video here and take notes off of this beautiful typed answers, but effectively it's the exact same thing. Remember, to get the standard quantity allowed for actual production, we have to take our standard allowed per unit times the actual production of final goods, the parkas. And then we could calculate that 490 actual price by taking the total that was given divided by the 210 actual kilograms purchased and used. If you want to do it out algebraically, this is the way you would calculate it. I don't do this, so I'm not going to explain it. I don't like the algebra. It's just a personal preference, but if you want to do the algebra, here's how you do it, and you'll notice, importantly, that we get the exact same answers. So it really doesn't matter the approach you take. You pick the one that you're more comfortable with. Why do we need to break down the variances? Well, because the person who's responsible for the different variances is different. So for the price variance, the purchasing manager is the one that controls that because they're the ones that negotiate pricing upon the purchase of the goods. The quantity variance, on the other hand, is the production manager's job. They're the ones overseeing the production of the product and making sure their employees are utilizing the materials efficiently. The standard price is used to compute the quantity variance so that the production manager isn't held responsible for the purchasing manager's performance. So if the purchasing manager spends too much, we don't want the production manager to be held accountable for that. That's why the standard price is used for the quantity variance. The materials variances are not always entirely controllable by one person. An example of this, the production manager may schedule production in such a way that requires express delivery of raw materials, which is going to then cause an unfavorable price variance because you're paying more than you expected because the production manager required the materials more quickly. The purchasing manager could also save money by purchasing low quality raw materials, and then the production manager is going to have a hard time utilizing those materials if they're crappy because there'll be a lot of waste, which will result in an unfavorable quantity variance. So bottom line is, in the real world, you get these variances and you want to hold the managers accountable, they're always going to point their finger at somebody else. So as upper level management, which I assume all of you want to be, you'll have to figure out who's telling the truth and what the real deal is, the real reason behind these variances. All right, the other type of question we're going to go through deals with Zippy, and this is going to be your chance to practice, so I highly recommend that you pause the video when we get to our quick checks, which will deal with Zippy throughout, and you try to calculate the answers. So this is the data that we're going to use for Zippy, and then we're going to answer a series of questions. What I recommend you do is pause on this slide and then go ahead and do your 3-column approach and figure out what the price and the quantity variances are, because that's what our multiple choice is going to have us go through and answer. So take a minute, give it a pause, and then come back and we'll go through and do it together. I know some of you didn't pause, shame on you, but the only way you're going to understand this stuff is through practice. And watching me do it is one thing, but being able to do it yourself is something totally different. Anyways, I'm going to set up my 3 columns: actual quantity times actual price, actual quantity times standard price, and then my favorite, my swap times my standard price. I'm going to do it the same way, but you'll notice that the format here is very much like the format we use with the glacier problem. You can't expect that on every problem on the exam, quiz, or homework. So you got to get more practice so you know that, oh, if it's red, it goes here. Well, that isn't going to work. There's no coloring on the exams. So please make sure that you understand that not every problem will be set up exactly the same way, but the concepts will be the same. So in this case, the standards are 1.5 pounds per Zippy at $4 a pound. So the 1.5 is going to be used to get my swap, and it's the standard quantity allowed per unit of 1.5 times the number of final products, which are 1,000 Zippies, which means that we have 150 as, I can't do math, 1,500 as my standard quantity allowed for actual production. My standard price is the $4 per pound. Then it says 1,700 pounds of material were purchased, so that would be my AQ, because we're looking for the actual quantity of materials, not final product. And then it said we spent $66.30. So like last time, I can get my actual price by taking the total $66.30 and dividing it by the 1,700. That gets me an actual price of $3.90. I don't really need it to get my variances, but I like it. And then to get my middle column, it's 1,700 times 4, which is 6,800. And to get my final column, it's 1,500 times 4, which is 6,000. And then we take our differences, 6630 minus 6,800. That gets me 170 price variance. We get an 800 quantity variance, and then we got to deal with our favorable or unfavorable. So the actual price, $3.90. The standard was 4. Good job, Johnny. You did a great job saving money. So that would be a favorable variance. That would also happen in total. If actual was $66.30 and budget was $6,800, spending less is favorable. And then looking at our quantity, we spent 1,700 pounds, or used, I should say, 1,700 pounds, and we were allowed to use 1,500. Shame, shame, Sammy. You used too much material, so that would be an unfavorable variance. Likewise, the total is 6,800. The budget was 6,000. Another shit show. We spent too much money, so that corresponds with unfavorable. We could check our work by adding these two together. Because they're different, you have to subtract. 800 minus 170 gives me 630. The unfavorables are the biggest. So we have an overall unfavorable variance, which indeed is the difference between column 1 and column 3, giving me confidence that I didn't screw anything up. Using this information, hopefully you got the same thing. You should be able to answer these several quick checks. So the first is, how many pounds of material should we have used to make the 1,000 Zippies? This is asking for swap. So I have a bad memory. My swap was 1,500. So boom, there is the answer. Next question wants to know the quantity variance. So we calculated our quantity variance to be 800 unfavorable. Here's the algebra way of doing it. I've already shown you the 3-column approach. The price variance was 170 favorable. Again, here's the algebra. I've already shown you the 3-column approach. You do you, and choose the one that you like most. Here is the 3-column approach, all typed up and pretty. If you don't like my writing, here's your chance to get some nice notes. The bottom line is, no matter how we do it, using algebra or the 3-column approach, we're going to arrive at the same answer. Now, it's really important to note that when we're getting our price variance, we're using the quantity purchased, because the price variance is based on how many units we purchase. The quantity variance would be based on the quantity we use. Now, this hasn't really mattered for the examples we went through, because the quantity purchased and the quantity used have been the same. But it's something I want to ingrain in your mind right now, that when the quantity purchased and the quantity used are different, we're going to have to set this up a little differently and basically use 2 separate middle columns. one middle column for the price variance based on the quantity purchased, one middle column for the quantity variance based on quantity used. And we'll go over this in a separate segment, but I want you to understand that this is going to be an issue for direct materials variances when the quantity purchased and the quantity used is different. Up until this point, all of our examples, the quantity used and the quantity purchased has been the same. And as a reminder, to get our SQUAP, it's the standard allowed per unit times the actual production of final product. So it's the 1,000 Zippies, that's our final product, times the amount allowed per unit, which is the 1.5 pounds. So the only time that the actual final product, the Zippies in this case, come in is when you're getting SQUAP. Don't confuse the actual quantity that we want over here for our AQ with the 1,000 Zippies. The AQ is the actual quantity of materials, not final product.